Okay, everybody, welcome to our Tom's Trade Essentials. This is the second one of these that we've done this year. I plan on doing these every couple of months, and what these are is a series of webinars where I take you through specific strategies and options. And what we're doing is this week we're going to talk about calls and puts, and we're going to do a little bit on option essentials. The next time we get together, we are going to discuss spreads. And we're not going to discuss just debit spreads or what I kind of coined the phrase a loophole trade, but we're going to also talk about credit spreads. And it's important we talk about what a credit spread is next week because the markets are really gifting us some really great opportunities in credit spreads. And this is something that I don't do a lot of publishing on. All right. I don't publish on credit spreads. And there's a reason why. I'll get into that when we talk next week. And then we're going to do a special week 3 where I teach you a layering system, how to do credit spreads and layer them into this particular strategy to actually create a method-based repeatable pattern using an option strategy that we don't care whether the market goes up or down. All right. So we'll get to that. All right. So these are going to be little steps that we take over the next month. Now, how do I do 3 classes and yet I do this over a month? Because next week I'm going to do something I haven't done in a long time, and that is I'm going to take a little bit of time off. I kind of promised the wife that I would get away from the machines. I've got several of them here, and take a little bit of time out. And so we are going to go halfway around the world. But at the same time, I'm still going to be in touch with what's going on. I mean, you can't take me away from this stuff. You can't drag me away from this stuff. Anyway, guys, I'm really happy that you're here. If you have questions, all right, you're welcome to submit them in the Q&A box. All right. I can guarantee you that I'm not going to be able to get to all of your questions because there are so many people that are in this room tonight. I'm pretty sure we're going to end up getting close, if not fill the room up completely. And there'll be some people that are going to be emailing saying I can't get into the room. And all I can say is this: congratulations to those of you that showed up on time, because you are in here for the live event. If I don't answer your question, and there's a high probability that I won't because of the amount of people in here, then you're welcome to email any questions that you have at support@tomgentile.com. All right. Before I begin, I do this in every webinar that I teach, and I teach a lot of them. In fact, this month, we actually here at Tom's Trading Room have 21 webinars that we are doing in the month of March. And that is webinars we do during the market. That is webinars that we do based on just of our tools, webinars that we're doing on some advanced strategies, and webinars like tonight where we're talking about trading essentials. So a lot of stuff going on here, guys. Before I begin, I talk about this disclaimer. I put this up on the screen. I have it up here, and I talk about this in just a moment that I do with every webinar I do. Couple things I want to point out. You can read this from top to bottom because you will be getting a recording of this live event shortly after the live event is over. Okay. Couple things I want to mention, and this is number 1. Stock and options trading has large potential rewards, but also large potential risk. You must be aware of these risks and willing to accept them in order to invest in the stock and options market. Do not trade with money you can't afford to lose. And the other thing I want to point out in here is that Jay Harris, who's in the room tonight, backing me up and is going to be going through questions and picking the most popular ones is what we're going to go for. We are your educators. Everybody associated with Tom's Trading Room LLC. We're your educators. All right. We're not your brokers. You need a broker to trade with. You must meet certain requirements. And everything we're going to talk about tonight is in US dollars unless noted otherwise. All right. Now, I got some new folks in here. And, I should have asked this poll, but I'm going to go ahead and throw this question out here. And, Jay, you can just check the Q&A board here. But how many of you are in this, are hearing me on a live webinar for the very first time? All right. How many of you are in here for the very first time? And the reason I asked that question is because If you're not, you don't have to answer that question. But if you are, glad to have you. We had a energy and opportunities report that was out there, and a lot of folks have come to us on that, and that's actually really doing well. We put that out. We talked about the energy and opportunities report for a couple weeks ago, and how funny is it that we were seeing the oil markets in the 20s when this report first came out, and all of a sudden now we're in the mid 30s. All right, and I've got my gun sights on 45 for oil. Anyway, that has driven a lot of our folks in here. Social media has driven a lot of folks in here, and then a lot of folks have been Googling myself and our company and just trying to find out more information on us. So if you're brand new to us, welcome. We're glad to have you here, guys. Let me tell you a little bit about myself. Like I said, you may be hearing from me for the first time, but you may know who I am and some of the things I do. I've been involved in the markets for over 25 years. I got started the same way a lot of you did. I got something in the mail, all right? Although it wasn't email 25 years ago, it was mail, snail mail. And I'll take you down memory lane. All right, I opened an account right at the right age of 18. And from that account, I ended up making a fairly large amount of money, and then I end up losing it all in pretty much one day. And that day was not October 19th, but October 20th, 1987. All right, the day after the market crashed. How in the world did I lose money the day after? Well, because I went in the day of, and I did a lot of things wrong. I did so many things wrong. I mean, the big three were: number one, not knowing anything about volatility and how wild slippage can be on a day when the market drops 25%. Number two, listening to the loudest person on TV. At the time, it was a program called FNN, the Financial News Network. A lot of you may know who that is now. And then number three, taking every dollar I had and putting it into one trade. So that was the poison pill. That was the perfect storm of what happened to me in 87. And I decided then I needed to make a decision of whether I wanted to do this as a career or move on. And I decided to stick it out. And I decided to learn things the hard way. And I stopped trading for a year. There was two reasons I stopped trading for a year. Number one is because I didn't want to take another trade until I really understood what I was doing. Number two, I didn't have any money. I had a margin call. If I had a margin call I couldn't meet, I had to pay back the broker. And so I told this story long ago that, with brokerage firms now becoming less and less personalized, if you want to have an intimate conversation with your broker, it's very simple. All you got to do is get a margin call. They'll be calling you. They'll be tracking you down. And I joke about that because I don't want anybody in here to experience what I experienced. And if you have, I don't want you to experience it again. So I've been trading for 25 years, and I'm pretty well versed in most areas of the market. I was the co-founder of a company called Optionetics, which several of you in here know that company and followed me in that company. And I'll be very, very blunt with you. The company was acquired by Options Express back in 2009 because me and my co-founder and partners decided that we needed to be on a larger scale as an educational business. Optionetics was the 800-pound gorilla in options trading. There was nobody bigger at the time. And we ended up merging with a company called Options Express. Well, lo and behold, 2 years later, we got eaten by the whale, which is Charles Schwab. All right, Charles Schwab then took some things that they thought were great with Options Express, some things they thought they were great with Optionetics. And long story short, my contract was not renewed. I was in a little golden handcuff thing, and I stayed around. And I told every student, I said, I'm not leaving unless they kick me out. Well, here we are. So anyway, it was a mutual thing. We're both, no hard feelings on either side. During that time, I was an author of several books in stock index and options markets. I used to be featured a lot on CNBC, Bloomberg, Reuters, Fox. And what I found out is I became being one-on-one interviewed to 1-on-9. It was like looking at the Brady Bunch, and you all know what I'm talking about. If you ever watch financial news, you'll see, 6 or 9 different people in there, and you're lucky if you can get 5 or 10 seconds of talk time. I decided that I wanted to go a different route, And I was hosting one of the biggest talk shows out in L.A. back in the 90s and into the early 2000s, and currently host a weekly talk show on iHeartRadio called Wealth Strategies, and that goes on Tuesdays. I also write publications for companies like Money Morning and Money Map Press. But I'm also the founder of Tom'sOptionTools.com, and that is a site where we provide proprietary tools in the stock and options markets that, frankly, nobody else out there has. And I say that because if all I did was have a software, a piece of software that could chart and do risk graphs, it wouldn't. Everybody has that. And this is a business where you got to be on the other side of everybody. That's what I believe. And so, that being said, let's go ahead and get started. So I have some questions for you before we move any farther into the program. And so the questions I have are this. And I'm actually going to put these out here, and I'm going to poll you with these questions. Now, these are multiple choice questions, but I'm going to engage you and make you part of this program tonight. So the first one I have, and this is for everybody, all right? And here it is. What is your experience with options? So I'd like you to select one of those and go ahead and submit your answer in. And your answers are, this is very simple, guys. You're either one of these four areas. You're brand new to options trading, and some of you in here are. All right. You have enough knowledge to be dangerous. That's an interesting category. All right. I have been in that category. I can tell you. I've been in the brand new category. I've been in the enough to be dangerous category. I know options fairly well. And that's the category you get when you get past the dangerous part. All right. And then this other category kind of tells me who you are. I'm one of Tom's partners, past or present. And the partners are a program we started a couple of years ago where we're doing some small trading with a small block of people, and we do some really very intimate, very focused trading on strategies and or systems. And so now I'm going to go ahead and close this poll up in 10 seconds, guys. So if you haven't answered, do so now. All right, lock in your vote, lock in your answer. I'm going to close this down. Let me find the closed poll. Going to do that.
Tom, they're answering on the Q&A board too, so
okay.
They might want to click.
Yeah, if you're answering on the Q&A board, we're not going to be able to see, because I want to actually show this. I'm actually going to show you the results of the poll, because it's important that you know where you fit among everyone else. All right, so again, brand new, enough to be dangerous. I know options fairly well, or I'm one of Tom's partners, past or present. All right, let's go ahead and close that poll, and let's share the results. And here you go. So this is what we're looking at right now, folks. 10% of the room is brand new with options trading. All right. Maybe you know what a call is and what a put is, but maybe not so much more than that. 40%, enough to be dangerous. So 50% of the room is definitely going to learn something tonight. All right. Now, those of you that are in the I know options fairly well camp, that 33% of you, I can guarantee you I'm going to teach you something tonight. All right. It might not be on options, but it may be on how we trade or what we trade. Okay. And then the 17% of you that are, I'm one of Tom's partners, past or present, congratulations, welcome back. And I may have seen some of you last night when we were doing Breakout Mastery. I might see some of you at the end of this month when we do Credit Spread Mastery. So anyway, glad to have you in, and I'm hoping I can keep your hoping that I can keep you educated as well. So let's do another poll. And the next poll I want to do is this is a different polling question, and this is, and I'm going to save the other one here for a little bit later. I got another question for you, but I'm going to launch one more poll for you. Here we go. How do you classify yourself as a trader? All right, I'd like you to select one of the following. Number one, I trade based on whether I think something is going up or down, for that matter. Okay. Number two, I trade based on fundamentals. Number three, I trade based on the technicals. That means you're a chart reader or you look at indicators to help you determine whether you think something is going up or down. And number four, I am a rules-based trader. Now, if you don't know what that is, that's okay, because we're going to talk about all four of these categories, but I'd like to know where you stand in those categories, all right? as we're getting the votes in right now. I think some of you are probably staring at this, trying to decide, well, I wonder which one I am. And if you're more than one, okay, folks, if you're more than one, let's say you trade fundamentals and technicals, then you would pick technicals because that's the next level up from fundamentals. Because some of us that trade fundamentals also look at technicals to help us determine whether we want to go long or short, all right, based on what the underlying values are. And that's perfectly fine, all right? And I expect, I already expect one of these to be significantly outweigh the rest, all right? So we're going to go ahead and close this poll in 5, 4, 3, 2, 1. All right. Poll is closed. Let's share those results. And right here, I trade based on whether I think something is going up or down. All right. I don't know why I didn't get the or down in there, but it's there, 14%. All right. Jay, 7% trade on fundamentals, 43% trade on technicals. And then we got 36% in here that are rules-based traders. Now, this is interesting. A couple things I'm gonna point out here as I sound like a CNN pollster. Number one is that the 14% that trade based on they think something's going up or down, I would venture to say a lot of those are the brand new option traders in here. All right. If you trade on based on fundamentals, you may be a longer-term trader, not so much a short-term trader. That's perfectly fine. Folks that trade on technical analysis are more slated toward that income type trading. That means they take trades in that 30 to 90 day camp. All right, maybe a little less. And then this is interesting. The rules-based trader, we got 36% of the folks in the room that are rules-based traders. Now, I think that's interesting because I know that half of those are my partners, but then there's another half of the group in the room that are trading rules based, and that's fantastic. And I want to teach you all in the room. If there's one thing I want to leave you with, not just tonight, but in week 2 and week 3, it's how to be a rules based trader, and there's a reason for that, and I'm going to get to that here very soon. So let's go ahead and hide those results and let's get started. So I've talked about some questions. Now, the number one thing that I look at before I even start looking at options is I want to create a list of stocks to trade options on. Now, my list isn't one that I'm going to handwrite on a legal pad or that I'm going to type into a watch list. It might be a little bit bigger than that, but that's okay. What we want to do is we want to start with the 25,000 stocks that are out there and start weeding some of them out. Okay. So one of the first places we can do to weed those out is take out any of the stocks that are not optionable. And I say that because if you don't trade options, there's another reason you want to take those out, because the ones that don't trade options are much less liquid than the stocks that have options that trade, because there is a certain threshold that the stock needs to meet in order to list options to trade with it. So that's one thing we can do. Is the stock optionable? Guess what? 4,000 stocks roughly are optionable. That means 21,000 stocks that trade on the exchanges are not, and they get thrown out to me. All right. Number 2, I will also want to look at whether I want to look at a liquidity piece. All right. So I find that the markets, the best tradable stocks are in 3 areas. And I talked about options. All right. We're going to get into what this means in a moment. But market liquidity, that means, can I be a small fish in a big pond? And this is a business where you want to be a small fish in a big pond. I'm going to give you an example of a big pond. Facebook is a big pond. Facebook is the most liquid, if not one of the most liquid stocks that's traded. Okay, Apple is another one too. But I'll tell you, Facebook, the options on Facebook, a lot of times I see those near money options, their bids and offers are a penny between the bids and offers. So market liquidity. Stock mobility is another thing I like to look for because I'm a certain type of option trader. Okay, and I like stock mobility. And I'm not saying if you don't like stock mobility that you're not going to be a successful option trader. I'm just saying, giving you an idea of what I do. All right. And then number 3, I find that if we have short-term options, those are called weeklies. All right. That's just another part of creating that liquid list. Okay. So if you really want to know where market liquidity, stock mobility, and short-term options lie, One of the places they lie is in something called the Penny Pilot program. So if you go search for the Penny Pilot program, this is a program that the Chicago Board Options Exchange created. And back in 2009, they decided to start classifying certain stocks as what they call Penny Pilot stocks. And that means that options would have the ability to trade inside the nickel between the bid and the offer. Basically, it means it's more competitive. You have more bidders and more offers trading inside of a 5-cent bid-ask window. Now, where do you find this? If you go to Google and you type in Penny Pilot Program, right, the very first thing that's going to come up is the CBOE Hybrid Penny Pilot Program. If you click on that, then you're going to get this link that pops up. And right in here, it says, click here for a .csv file of Penny Pilot classes. If you click on that, you can actually download the file of all the stocks that are liquid optionable trading stocks, right? Now, you can take it one step further and you can actually download the list of weeklies. And then what I like to do is I like to find stocks that are Penny Pilot that are also trading weeklies. And you know what that narrows you down to? About 250 stocks. So guess what? One of my phrases is I like to call myself a one percenter when it comes to trading. All right. Trade like a one percenter. That's a book I wrote a couple years ago. And so when I trade like a one percenter, one of the first things to do is cut out 99% of the stocks that you don't need to be getting into as a trader because they will eat you up in slippage. Right. So if we deal with the top 1% of all stocks out there in liquidity, and we do that looking at this Penny Pilot program, we're going to have the ability to narrow ourselves down to stocks that and options that trade very efficiently. So that's the first step I wanted to give you. So my essential one percenter list is that we take that list and we narrow it down to the top 1% of that 25,000 stocks. Now remember, once we do that, we're not done. This is an ever-changing list, all right, which I look at about every 3 months. But remember, it consists of simply two things. Number one, stocks on the Penny Pilot list, cboe.org. Number two, stocks that trade weekly options. Guess where you can find those at? cboe.org. All right? It's free. Go download it. All right? That's the Chicago Board Options Exchange. And they give you those lists, and they update them on a regular basis. I find about every 3 months I can call through those and look at those. So, what is an option? That's the next thing. Now, I'm going to get into this, and then I'm going to jump into my tools, and we're going to look at some real-time case studies. And then I'm going to come back and forth, so that those of you that know a little bit about this hang tough with me because we're going to look at some real case studies. What is an option? Well, an option consists of two sides. Just like when you're buying a house or you're buying a car. All right, if you buy a car, if you go to the automotive dealer, you're the buyer, who's the seller? The seller is going to be maybe the salesman, all right? And the salesman's kind of like the broker for you. There's someone that sells, and then there's someone that clears that car for you. All right, that processes the paperwork and gives you your title or gives you your loan on the car, whatever it may be, but they end up being the person in the middle that facilitates the trade. Same thing happens in the stock market. Same thing happens in options. For every buyer, there is a seller. All right. A buyer would buy an option and they're going to pay for that option. Where a seller would be on the other side. They would write that option and they're going to accept payment for writing that option. Now, you might wonder, why is there a seller for every buyer? Well, it's very simple. If for every person that thinks Facebook, for instance, is going up, there's someone equally convinced it's going down or it's going to stay sideways. All right. And that's what makes a market. Buyers and sellers make a market. And so I'm going to bring up some stuff on Facebook in just a moment. But let's get through a couple of other little quick things too. There's two types of options, calls and puts. All right. Now I'm going to focus on the buy side tonight. And what I mean by that is that if I buy a call or I buy a put, all right, one thing you're never gonna hear out of my mouth is something called naked selling, naked call writing, or naked put trading. All right, because I see it and I get it. If you trade naked puts, you know what? God bless you, because you are taking a lot more risk than you could. All right, I'm going to tell you next week. I'm going to show you how you can sell that put or even sell a naked call and protect yourself. But for right now, I don't trade naked, or I don't trade naked options. And it's simply because the obligations are too risky if things go in the opposite direction. And so, I wrote an article on this recently, looking at Disney, where we looked at Disney and we saw what happened with Disney. That Star Wars was coming out. Actually, my radio show, which was this week, I talked about Disney. I talked about the fact that someone could go in and they could think, wow, Disney's going up. This Star Wars movie is fantastic. I'm hearing it's getting record numbers in, and I'm going to look at Disney. And you might look at Disney, you might say, wow, hey, you know what? The stock's trading at a certain price. I'll go ahead and let me write the puts, because I heard that it's just like getting a stock, but it's cheaper, and then it allows me to buy down on the stock. And that's what a lot of people understand about naked puts. And what they don't find out is that that $106 stock on one day becomes a $96 stock the next day. If you wrote that put option, maybe you took $2 in. That's not going to help you when you're down $10. All right, you just went $8 in the negative. We're going to concentrate on option strategies that had limited risk and that give you rights, not obligations. A call gives you the right to buy a stock. A put gives you the right to sell a stock. All right, so we look at calls when we're bullish. We look at puts when we're bearish. Option contract size. All right, just remember this: 1 equals 100. What does that mean? That means one contract is good for 100 shares of stock. So in some countries, one contract is good for 1,000 shares, but that's becoming really less and less. But for American exercised options, and even European exercised options that are listed here in America, 1 equals 100. So that means what? Well, that means if you were buying, and I'll give you a really good example, Priceline.com, all right? One of my favorite stocks, and I think it's one of my favorite stocks because we've done so well with it. $1,300 a share now. I mean, this thing is just, it's just been all over the place, right? Not even 3 months ago, it was near 1,500. Then it dropped to 950. And now, within a couple weeks, we're back up to 1,300. $1,300 a share means if you bought 100 shares of that stock, you're going to pay $130,000, right? But you could buy the options, and maybe you end up paying $3,000 to rent the stock. And now you're paying less than 3%. You're paying around 2% of the cost to control 100 shares of stock, or a value of $130,000. So option contract sizes, every one contract is good for 100 shares of stock. All right. Next, as we move on, option strikes. Now, option strikes, this is where things get a little bit more dicey, because if I'm looking at Priceline.com right now at 1,300, and maybe I want to buy those calls, well, which ones do I buy? The right to buy it at 1,300, the right to buy it at 1,250, the right to buy it at 1,350. Okay, these are all what are considered different versions of strikes. So if your stock price, for instance, let's say our stock price is at $100, and I'm using XYZ as my example here. All right, and I buy the XYZ. Let's say that I have the 100 or the 95 strike. Right, so I have the right to buy XYZ at 95. If the stock's trading at 100, then my 95 call is what we call in the money. The reason it's in the money is because I have the right to buy XYZ for 95. If the stock's trading at 100, I've got something that's worth at least $5. I could buy it $5 cheaper than the market's trading it for right now. So that's going to be worth at least $5. All right. Then we've got what's called at the money. That's when the strike price and the stock price are equal. And we have what's called out of the money. And out of the money is when the option strike is away from or farther out from the stock price. And you might wonder, why in the world would somebody buy a 110 call option when the stock's trading at 100? You're buying something that's 10 points away from where the stock is right now, because your perception is that the stock is going to be trading above 110 before that option expires. Okay, a good example would be Priceline. All right, if I were to look at Priceline, let's go back and look at Priceline for a moment. I'm going to take you down memory lane here. So let's just move into, where's my trading tools at? Oh, here they are. Sorry, guys, lost the video there for a moment. Trading tools. So I'm going to bring up, let's go over here. And let's look at PCLN. PCLN. Now, one of the things I get to do in my tools is I get to hit the Wayback Machine. And the Wayback Machine means I can go back in time. And I want to go back to before Priceline's earnings came out. And let's look at September 7th, because that was a very interesting day in the market. I believe it's September 7th. That might have been a weekend day, but we're going to find out here in just a moment. Okay, so September 8th was a Monday. Right, and September 8th, we're looking at Priceline, and I'm going to go ahead and I'm going to look at the third week in February. So that's the options expire in February. By the way, I'm going to come right back to this for a moment, because it just dawned on me that I need to talk about one more thing, and that's expiration. So options expire for the most part every single Friday. Weeklies will expire every single week. We have an option expiring with the most liquid stocks that have weeklies. There are some options that don't trade weeklies, and they expire on the third Friday of every month. Okay. Then there are some options that expire. They're called monthlies, or end of the month. They expire on the last trading day of the month. Okay. Then every March, all right, every March, June, September, and December, we have what's called quarterly options. There's some options, some securities that have quarterlies that expire at the end of every quarter. All right, so you can download the expiration calendar that I have right here by going to the Chicago Board Options Exchange. But I can tell you this, that if you're trading liquid stocks like I do, then you're going to find several different option strikes for each of those. Let's go back and let's take a look at Priceline.com. So I'm looking at remember, now we're back on February 8th, and we're looking at options that expire on week 2 of February with 4 days to expiration. All right, the third Friday, which expires 11 days to expiration. That's because we're looking at February 8th. Let's come on down, and I just want to show you a couple things. Here's the options that expire 11 days before expiration on the 19th of February. And I want to show you where Priceline's at. So Priceline's at $973 a share. All right, and you can see the 975 calls. All right, they're trading for $51.60. Now, what if I told you, if you bought that, first of all, you're still going to pay a lot less than it would cost to purchase 100 shares of that stock. I'm going to show you right now what you're going to pay. Still going to be expensive. It's $5,000, $5,160 to be exact. All right. Now, here's your payoff graph. We're going to talk about that in a moment. But I want to show you what happened to this if we just move ahead. And let's go up to 10 days ahead, the 18th. So the 18th comes around, and Priceline does a jump. And all of a sudden, your $5,000 options are now worth $22,735. Now, what if I told you that we actually saw that pattern coming, that we had a high probability pattern on this in 2 cases, not in just one, but we had 2 overlapping patterns that was telling us that Priceline to expect a jump within those next 2 weeks of trading at that time. Absolutely. I'm going to show you what it is here in just a few minutes. But getting back to what we're talking about. So we're talking about a $130,000 stock that we can actually buy options at $5,000 for. Can we make them cheaper? Yes, we can. I'll get into that later. But for right now, getting back to strike prices. So I'm going to turn the tables, and I'm actually going to update us back to today's date. And I want to change this to Facebook. All right, we're going to look at Facebook options for today. So I'm going to look at Facebook options today, and I want to look at 2 different types of options. I want to look at the options that are expiring this week, and I'm going to look at the options that are expiring in 2 years. And I want to show you those for a reason. Number 1, if you look, and I'm looking 5% above and 5% below Facebook. I'm just looking at a few options. So here, what you're looking at is you're looking at the calls and the puts for Facebook that expire the day after tomorrow. All right, they expire on Friday. And you're going to see some colors in here, and I'll explain what these colors are in a moment. But this is the most important part I want you to look at right now, and that is this part. All right, this is the Facebook March 16, week 1, 110 call. Where's Facebook trading? It closed at 109.95. So this is the at the money option. It's right there. It's right at the money. All right, it's a nickel from being spot on. 85 cents. So if you believe that between now and Friday, Facebook is going to be maybe a $115 stock, then if you bought this option for 85 cents, it's going to cost you, remember, it's this times 100, because remember, one contract equals 100 shares of stock. So if I buy this Facebook option for 85 cents, remember, it's $85. But it's a 2-day option. That means in 2 days, it's either going to be worth something or it's going to be worth nothing. And you're going to either make some money or you're going to lose the $85, right? Only 2 days. Now, let me show you another one all the way down on the other side. Look down here. There's a lot less strikes. There's the 105. Now, notice here, we have the 110, the 111, the 112. Every dollar, we have dollars going up and down on Facebook for the weekly options. The ones that expire in 688 days got a little more time frame. 110, 115, 105. These are 5% above and beyond. There's more strikes. I don't have the room to show them to you or the time right now. But look at the 110 calls, $21.60. All right. This is telling us that the market makers and all the bids and offers that are coming in are telling us right now that there is a percentage chance that Facebook is going to be up above $130 between now and 688 days from now. All right. That's called a standard deviation. All right. Now, I don't want to get too technical with you. I don't want to get, I don't want to lose people here. Just realize this: 2 days to expiration, cheaper options. 2 years to expiration, a little more expensive. I will say this, though. Take a look at this. This is kind of what I call buying in bulk, right? How many 2-day options would you buy to get to $21.60? So, I mean, really, if we round this up and we just call it $1, all right, then you'd say, wow, okay, if I bought 20 of these, that would consume 40 days of option time value. All right, let's make it 50, and that'll get us up to around $21 in time value. 50 days, look here, I got 688 days. So this is what's called buying in bulk, right? Your time value will slowly diminish as you go out farther and farther. But don't expect this thing to take off really fast if Facebook goes up 5 points. In fact, look at the difference between the 110 call and the 105 call. The 110 call is 121.60, or it's 21.60. The 105 call is only 24.13. It's gone up, $2.50. Where over here, you'd see a 5-point rise. From 110 to 105, 85 cents becomes $5. So there's a lot more movement in this area here. And that's what we call options gamma. All right, and options gamma is how much this thing will move from dollar to dollar. Now, the movement within that is called an options delta. And so what that means is that if we see a dollar increase in this option here from 110 to 111, we should expect to see that option increase by what? 49%, 49.5%. So that 85 cents is going to go up by another roughly 50 cents. Look at this option down here. The 105 call is trading for 5. If we go from 109.95 to 110.95, this option should increase by 96% of the dollar. So we should see 96 cents get added onto this $5, where over here, we're going to see just 50% of that, not 96% of a dollar movement. So that's what that means. Okay, these colors, well, these colors help tell me some things, like, for instance, options that are the most expensive. All right, options that are the cheapest are in blue relative to the chain that we see here. The yellow would denounce the best, what's called double finder, percent to double. All right, and I'm hoping to talk about that tonight. If not, I'm definitely going to cover it next week. This green area tells me the most volume on the call side. All right, and this orange area is the most open interest that's on the call side. We have those for both calls and inputs. So I can easily look, and my eyes can easily scan and say, all right, what's cheap, what's expensive, and what's being traded right now. And those are important when I'm looking for different options. But again, not the most important thing, because if anybody in here who's followed me for any length of time knows, the most valuable indicator of liquidity, it's not volume, it's not open interest, is the difference between the bid and the offer. Look at this Facebook bid and offer, 84 by 85 cents. That is absolutely amazing. You can't get inside of a penny unless you trade Forex. That's it. All right. Look at this one that's in the money. 144 by 148. 4 cents difference. Amazing. Absolutely amazing. And that's the most liquid stock. Now, The problem with too much liquidity is you don't get the kind of crazy movements like you do with a Google or a Priceline.com, or an Amazon.com. So, we try to look for both. We try to look for liquidity and mobility. All right. So that's a little bit on options, strikes, expirations, contract size. If we were to move forward, all right, what we're talking about here, folks, is creating what we call risk graphs. And these risk graphs that I'm going to create with you tonight have one thing in common. They have limited risk. They have a lot less risk than the stock price itself. And in the case of the long call, they could have upward reward until we take the trade off. Targeted reward. Unlimited reward is what it's called, but I call it limited till you can't stand it anymore and you got to get out. All right, if you look at these other risk graphs, these 4 risk graphs here have something in common too. They have open-ended risk. Long stock to 0. All right, short stock is unlimited risk. Short call, unlimited risk. Short put is limited to 0. Right, or unlimited to 0. But keep in mind, what we're going to deal with tonight is limited risk trades. In fact, that's what I typically deal with only, is trades that have limited risk. All right. So when we put all of this together and we start looking at analyzing option positions, these are some things that I want to look at. I'm looking at option types. Am I bullish or bearish? Am I going to be looking at calls and puts? And I could look at a combination of both. All right. What option strikes am I going to be using? In the money, at the money, or out of the money? I use them all. But you know what I do? I use in the money on certain occasions. I use at the money on certain occasions. I use out of the money on certain occasions. And these I want to teach you. Next, expiration dates. Am I a short-term trader or am I a longer-term option investor? And it really all depends on the opportunity, the trade risk, and your trading plan itself. So what I want to do now is I want to actually move forward and let's do some case studies. So let's go ahead and move over and let's do some case studies. Jay, are there any questions that are out there that you're seeing asked more than once that you want to pose to me, please?
In regards to the content, no. Most of it is logging in questions and that type of stuff, but nothing related to the specific content, Tom.
And by the way, I want to let all of you guys know about something. I'm playing around with something here. So my brother Mike, okay, some of you guys know who he is. My brother Mike, until recently, never hadn't traded an option before in his life. All right. In fact, he actually took his first real option trade very, very recently. And Jay had something to do with this. My brother Mike came to me not too long ago and he said, "Tom, I want to learn how to trade." And I said, "Mike, you're like 40. You're like 46. You've known I've been doing this for over 25 years. Why did you wait so long?" And he said, "Well, 2 reasons." He said, "I had a job and I was perfectly happy with that. And then and what happened was he ended up, his company got bought. And all of a sudden he started getting nervous because he realized that job security just isn't there. And he's got to come up with something else. And number 2, his son is trading stocks. And he wants to be a little bit more educated when his son wants to communicate with him and talk about stocks and option trading. But he's really doing it because he wants to create that additional income. And I think it's really cool. And I thought, man, I don't know if I have the time to do this. And Jay, what did you say to me?
I said, help a brother out.
You said, help a brother out. And I thought, wow, that could be the name of a really cool little segment we do. So I actually do about once or twice a month on the radio show, I do a little segment called Help Brother Out, where, I taught Mike the basics of options, how to open his first options account. All right, that was fun. I actually recorded that. I'm hoping we can put that together and make it live as a video for everybody. But how he opened his first options account, setting up his first trade. He did back testing, folks. He back tested for 60 days before he took his very first trade. And I'm really proud of him that he did that, because a lot of times, you want to just, your emotion, you just want to jump in and just really get into it. But he held back. And, I'm really excited for him because he is not a trader. All right. He did not follow the path that I followed. He was very he didn't like risk. He liked to take the safe road. And now he realizes that the safe road isn't as safe as he thought it was. So I'm actually kind of showing him the ropes and options. And those of you that follow me on regular webinars, or if you listen to the show, you'll get an idea where he's going. And I don't know the outcome. That's the great thing. We don't know the outcome on what's going to happen with Mike. But yeah, we're gonna be pushing the Help a Brother Out series here in the webinars, and I'll update you guys on how he's doing. But he did good. I mean, he's got his first trade underway. He said it was really kind of exciting, and now he's into mode where he knows his entry. He got his entry price he wanted, and he knows his exit. And that's the important thing, is that you have an exit plan. So let's go ahead and talk about a couple of trades here. So those of you that think, you're thinkers out there, maybe you think that Facebook is going up. All right, I'm going to show you something real quick. So let's go back and let's look at, let's do some thinking here, and let's go think all the way out to, say, May. All right, so I'm going to add a new cycle in here, which is the May options. They expire in 79 days. So those of you that are in that kind of 30 to 90 day trading strategy, you look at Facebook, you're thinking, all right, you know what? I think Facebook could run up. And looking at the chart, and let's go bring up a chart of Facebook so we can all look at the chart. I have some pretty cool charts here that not a lot of people have. And that's this chart right here. See this chart? This has got Facebook on it, but it also has Facebook's option prices and the gauge, the option gauge. Are they expensive? That red line would be at the top. Are they cheap? It'd be somewhere near the bottom. Right now, Facebook options are actually looking pretty cheap. And if you look at where 118 is, which is the high for the all-time high for Facebook, it's a good argument to say if we bust out of 118 that 120 would be the round number support. So we're trading around 110 right now. If you believe that you think Facebook is going to go up to 120 by then perhaps you'll be looking at some options in May, and you say, all right, the 110 calls. What if I bought the 110 calls? I'm going to buy one of the May 110 calls. I'm going to hit the risk graph button, and I'm going to look and see that call option risk graph that you see here. Now, we have ours on our side, and then we call this the modern view. And that's the reason why we look at the modern view, is because I can look at anywhere on this chart on the left-hand side, and I can move my mouse over and I can get an idea what it's worth. Like, for instance, if Facebook goes back down to $90 a share, and I bought these 110 calls, and I paid $6.80 for them, guess what they're going to be worth down here at 90. All right, just hold my mouse there for a moment, and it shows a profit, not a profit, but a loss of $652.98. That's a theoretical loss, because this software has the ability to help gauge, based on price, time, volatility, days to expiration, and interest rates, what that option's theoretically going to be worth. Now, if we went up to 120, and by the way, I'm going to come down here, and I'm actually going to change my stock price limit to my target of where I think it's going to go, which is 120. We'll reset that risk graph. And I want to show you what that's going to show us. So if it were to jump today from where we are now, if it were to jump to 120 today, we could see a profit of $648, which is almost a 1-to-1. But if it took until May for this to happen, we would see a profit of $320, which is only about 50% of what we see here. Now, I like doubles. Many of you guys know in this room, I like doubles, all right? Can't always get them, but I like them. In this case, I'm projecting myself between now and May to maybe make half of a double. So perhaps I move on, all right? Now, there's a couple of reasons why I showed this as a case study. Number one, because it's a big popular stock. But you know what? The other reason I showed it to you is because this is right now, to me, a thinking man stock. Because there's no pattern that I know of out there that's helping me with Facebook right now. Maybe one pattern, and I'll show you what that is. But right now, I'm not seeing any high historical probability that Facebook's going to move decisively higher. So I tell you that because I want to come back and I want to talk about a summary of styles. Okay, styles, and we talked about this, discretionary, these are the thinkers, fundamental traders, technical traders, and what I call the RBT trader. All right, so our fundamental trader, and I'll kind of show you how I categorize. I'm all of these. I was all of these. I started here, then I moved here, then I moved here, then I moved here, from discretionary to fundamental to technical to RBT. Here's what I found out about discretionary traders. These are the ones that are that watch TV and they trade from their gut. Let me tell you something. Your gut is the easiest way to trade. It's the laziest way to trade. It involves really no homework at all, no skills. You can flip a coin, right? In fact, flipping a coin actually is harder work than just saying I think something's going up. It really is. So I call that the lazy form of trading, and it just never worked for me. If it works for you, keep doing what works for you. Didn't work for me. Next, I started getting into fundamental trade because that was back in the 80s, that's what I saw. And I found out that fundamental trading is really more geared for the longer term trader, more like an investor, because fundamental information comes out, the drop dead information comes out once every quarter. So, we're looking at 90-day blocks here. Then I got my hands on some technical analysis software. Here's a question for you. Here's my question, you guys, because I know a lot of you have been, successful or not. You've been in this business or this hobby, whatever you want to call it, for some time. How many of you remember what your very first trading software was? All right, I want to see what kind of old school we got in this room. What was your earliest trading software that you were using for technical analysis? Howard, that was exactly what I used. Constantine, I have no idea what that is. Wall Street something. That's a great one, Jeff. I like that. TradeStation? Yeah, I've used that too. That's a tough one. They have something called Easy Language, and let me tell you something. It's anything but easy. Let's see what we got in here. Wow. I mean, like when I look at see Ninja Trader come up, that's fairly new. But I'm going to tell you what I used. I used something called Metastock. And I used the Metastock for DOS. Do you guys know what I'm talking about? The Metastock for DOS? That was my very first trading software. Metastock for DOS. Not Windows, DOS. And I actually had to use those little arrows on the keyboard to move around in. That gives you an idea of how old I was when it came to software. And so, when you look at that, technical traders, sometimes technical analysis can be quite confusing. And the reason I say that is because there are so many indicators out there. Let me tell you about what 99% of those indicators represent. They represent either price or volume. Okay, and indicators are just a different number crunching, if you will, on price, and a lot of them are based on lagging indicators. So technical traders a lot of times use the past to help to predict the future, and they use past price. All right, and I find that price sometimes is a very hard way of trying to gauge whether a market's going up or down. But here's the thing: whether you're fundamental, whether you're technical, it's one thing to look at indicators. It's something completely different to create a set of rules out of it. And a set of rules are what we do, which was called an RBT trader. So an RBT trader is, before I even ask this question, let's see, I've got one more poll to give you guys. In fact, no, I'm going to do that next. But an RBT trader is someone that does this. They convert that pattern, that technical pattern, maybe that fundamental pattern. We've got some fundamental patterns we use in rules-based trading. Happens about once a quarter. So we convert those patterns into a set of rules for entry and exit of the markets. We then back test those patterns vigorously, and we even forward testing them before we take any real trades. All right. And then after that, we follow those rules to the letter, because that's the only way you can replicate on-screen results. All right. If you want to replicate someone or something that's successful, there's only two ways that I know of doing it, or maybe three. Number one, you give them all your money and then they trade it the same way they trade theirs. All right. Now, that might be kind of a dumb thing to do because you may not know that person. All right. That's a lot of people did that with Bernie Madoff, and look where it got him. And it turned out he wasn't trading what everyone thought he was. But, that would be pile all of our money together and one person trades it. The second thing would be to really follow to the letter that group of systems or strategies that they do. All right. Shadow trading is what I like to call that, where you shadow someone. All right. And that's what I want to teach you tonight. Is I want to talk a little bit about how to shadow me. not only on option strategies, but the opportunities that I look for. And so when I say that, my next poll I want to launch is, if you're not currently an RBT or system trader, would you like to learn how? And so here's your poll, your next poll. I'm happy with my current trading style. And you know what? Some of you are. And I'm perfectly fine with that. And you know what? Some of you are in here and you might say to yourself, you know what? I am happy with the way I'm doing things. And I want to learn how to use options to maybe make my trading style better. And if that's who you are, you're still in the right room. All right. But if you're in the second category, I am open to anything that can make me money. That is me. All right. Hey, let me tell you guys something. You know where I was last weekend? I was in New York, and I was at the Traders Expo, the New York Traders Expo. I wasn't there to speak. I was walking around checking things out. Now, you know what? I knew half the people there, right? Because it is a small world. And I went to go see my buddy Jeff Hirsch. I said hi to him. And I saw Mark Chaikin, and I sat down and had coffee with him. And I saw some other people as well. But you know who else I saw? I saw a lot of my students. In fact, there was a woman walking around with a cell phone that was following me and my wife. And she finally got the courage up to come up to me, and she goes, "Are you Tom Gentile?" And I said, "Yes." And she said, "Hang on a second." It's just she grabbed her phone, put it to her ear, and she goes, "Yeah, it's him." And I thought, "Oh boy, where's this going?" And then she looks at me and she goes, "My husband wants to talk to you." I'm like, I'm thinking, what's this conversation going to be like? It turned out to be one of our students, one of our elite trader students. He said, "Hey, what are you doing? I'm in Houston now." And we had a good little quickie conversation. It was good to hear from him. But as I'm there talking to him on the phone, more and more people all of a sudden see me, and I'm shaking hands. And I really went there just to see who was doing what. And, because to me, as a rules-based trader, I will never say that I've learned enough. And I think that's important that you know that. So I'm open to anything to make me money. And then the last one here is, why do you think I'm here? So let's see how this poll turned out. All right. Not as many of you answered this one. About half the room did. I'm happy with my current trading style. That's fantastic. Look, there's a 1%er there, Jay. I'm happy with anything, or I'm open to anything to make me money. 67% of you said that. And then 32%, why do you think I'm here? So obviously, the large majority of you are here to learn not only how to trade options, but maybe some systems and strategies that can help you enter and exit options correctly. There are three types of option traders when I look at options trading, folks. There are option traders that focus just on price, all right? And then they wonder why they lose more often than they win. Those are a lot of times the thinkers, okay? And then there are the traders who focus on price and time. And they do a little bit better. They're kind of like the folks at the guy that rolls up to the blackjack table, and he knows basic strategy and he's got his card there, and he's hanging out for a while, but he's not making any real fantastic money. And then there's that level 3, that third dimension to option trading, and that is what I like to call that dynamic trader, the one that looks at price, time, and volatility. So you're looking at price and time, but you're also looking at the volatility of the options, and you're basing your option strategy on what the options prices are currently going for. So, these are two of several different types of strategies that I use, and one's something I call the money calendar. I'm actually going to show you that. And there's also one called DarkNet contrarian signals. The money calendar is really a price and time pattern. And what we do with the money counter is that I go back and I look at a minimum of 10 years back tested data. I'm back testing 10 years back. Now I am looking for high historical probability that a stock is either going up or down. Next thing I'm going to do is I'm going to then look at options and see if any options that I'm looking at in the wheelhouse fit that price and time. And then I want to see what those options are trading for. Are they expensive? Are they cheap? All right. And if they're expensive or cheap, that'll help me determine whether or not what type of option trade I'm going to put on. DarkNet is a little bit different. DarkNet is a swing trading system. All right, it's kind of like Elliott Wave. So any of you that know what Elliott Wave is, and I still am. I'm a big Elliott Wave fan. The problem I don't like with Elliott Wave, and I've said this to the Elliott Wave Institute for years now, is that, the problem with Elliott Wave is that if the market goes low or goes high, that count changes. And there's nothing I can't stand more than a wave count that I get into the market and then the count changes and it throws me off my game. DarkNet, what we did here is we actually looked at a contrarian version of what we call channel collision. And channel collision allows us to look at short, intermediate, and long-term trend channels. And when they collide together, we like to say when channels collide, price change is imminent. All right, and most of the time it is, and I'll show you this here in a moment. But we're going to look at both of these, and what I want to do is I want to take a look at these strategies, and I want to create some option trades. All right, so that's what we're going to do. So let's jump back into the tools. And so what I want to do now is let me go through, and I've got a couple of them here. I got to get rid of some of these windows here. Stock chart's great. Okay, so DarkNet. So I'm bringing up DarkNet, and I'm clicking on my DarkNet channels button. And here's what happened today. So DarkNet scans hundreds of stocks, all right, not thousands, but hundreds. And we've got 3 potential stocks that have option trades on them. Now, these are ranked by something that I call the percent to double rule. And the percent to double rule is the smaller that number is, the more likelihood the option I'm looking at has a larger chance of doubling with that smaller move. As you can see here, ResMed is the stock that we're looking at first. And so let me bring this up a little bit more. So ResMed RMD, that is a buy. So we have what's called buys and rebuys. Now these are based on channels colliding, all right? And I'm going to show you how we go and back test this. But I'm looking at, it's got some great slippage, less than 1% on the price of the stock, all right? It's got, my delta is actually a 69. That means that every dollar that this moves, I should expect a 69-cent move in the option. Stock goes up $1, the option returns 69 cents, right? The only problem is the stock goes down $1, the option is going to take away 69 cents. And this is a moving target too, all right? But here's how we rank this, percent to double. So I'm going out here and I'm trying to get a double finder, in this case, 7% of the stock. I need the stock to move up 7%. And this April 16th 55 call option, which is trading at $3.15, is likely to double. So I want to show you what we can do with this. So I'm going to look at stocks. I want to find out how well RMD has done in the past. So I'm going to go to stocks, and I'm going to go and I'm going to do a little back testing. And I'm going to type in RMD. All right. Now, we have some fairly lengthy webinars on actually how to use these things, but I'm just going to walk you through it real quick. So I want to look at math expectation, which one's had the best win-to-loss ratio. And let's go 5 years back. So that's going to be 1,500 days. And I want to look at all the buy and sell signals on this stock. So I'm going to click on search. Remember, 1,500 days back, bam, we're done. Okay, so percent profitable per stock. 100% profitable, percent profitable per trade. 83% of the trades were profitable, right? And if you look down here, you can see that this went back. It had 10 trades, all right? Oh, excuse me, it had 12 trades, 10 winners, 2 losers. The average days in this trade was 31 days. The max profit was $278. The max loss was $52. This is on the stock, folks, not on the option, okay? So now I'm already looking at this and I'm saying to myself, all right, this is good. I like this trade. So I'm going to go back and I'm going to look at RMD. I'm going to go over here and I'm going to look at this call option. So we're going to look at this call option. Remember, we're not selling anything naked. We're buying the right to buy RMD, ResMed. And what do we need ResMed to do? We need ResMed to go up 7%. What is 7%? 7% is roughly about... we'll call that $4 maybe. You know, there's something else that I missed and I wanted to show you. And let's go back and look at this one more time. All right. I messed up on this. I want to show you the chart. I want to show you the buys and sells on here so you can see it for yourself. 1,500. Hey, it's a live event, you know. It's not pre-programmed, guys. I don't have all these things all kind of in a nice little nifty pattern to show you. Here you go. That was my stock list. We'll do that on another day. I wanted to look at just RMD. That was the stock that came up today. So again, there's my 10 winners and 2 losers. And if I click on dark, that's what I want to do. I want to show you what's happened here in the last, looks like 6 months. See, I buy right here. That was when we had channel collision. We had a rebuy About a week later, there's your sell. All right. So buy, sell, rebuy, sell. And then over here we had the buy rating that came today. That was the buy on ResMed that came in today. So I wanted to show you that as how we can look at these, and we can go back and look at these. I have years of data. We can actually go back years and years and look at these things going farther back. But right now, 5 years back is giving us 12 trades. What does that tell you? It didn't take that many trades. This thing doesn't take trades all the time, right? Within 5 years, if it only had 12 trades, we're only talking about 2 trades a year, roughly, right? A little bit more than 2 trades a year. What's the option look like? Well, the option is a $312 option, call option on a stock. Now, based on there's those buys and sells that came up. There's the chart, the DarkNet chart right there. If we get a 7% jump, all right, that would put us somewhere around, let's call it 50 instead of 55. Well, we know 60 would get us around 9, so let's call it 59. So if I move down here and I put my upper graph to 59 instead of 69, it'll give us a good idea of where this profit tops out at. Is it going to be closer to a double than that Facebook trade? All right, well, here we go. And remember now, this is what we're looking at is about a 30-day trade. So I'm going to look at the blue line because my blue line is going to give me a better idea of where we are. Again, about $113, so about 50%. The difference between this trade and the one on Facebook, this one gives us a reason to trade. Facebook is, I think it's going to go up. I think it's going to go down. I can't backtest think. I can't backtest. All right. I can backtest rules-based trading. So this is an example. All right. And I want you to write this one down because this one's important. We're going to be doing some homework on this one. All right. Symbol is RMD. What did we do? We're looking at buying the April 55 call. All right, this is the April, the one that expires on the third Friday of the month, and $3.12. So this is a 44-day option, right? I'm not looking to be in this for 44 days. I'm looking at the average of 30 to 31 days in this particular trade. Now, that is DarkNet. As quickly as I can possibly get through it with you. Now, another particular example that I talked about that I was going to cover was the money calendar. This is probably the easiest trading strategy that I have dreamed up. And this one took me years to put together. In fact, we filed a patent on it last year, and we are very positively expecting to get granted a utility patent on this because nobody is doing this type of way that we are doing this particular style of this system. What we're doing is we're taking the top 400 stocks. We rank them going back 10 years to find which ones have the best probabilities going higher or lower. Let's take a look at Money Calendar. So I have Money Calendar here within Tom's tools as well. So when I bring Money Calendar up, the very first thing that I look at is I get a monthly chart. And that monthly chart gives me the overall month of the market. All right. Jay, are you there? Can you pop in here for a second for me?
I am here.
Okay. Tell the folks here what the month looked like. Let me bring up February here real quick. So here's February. All right. Now, what does this tell you as a trader when you're looking at the overall month? Talk about the little buttons here for a moment, or the number of trades and what the bullish and bearish mean and what the overall view means.
Well, you're looking at a color coding first and foremost, and the darker the green, the more bullish the day. The deeper the red, the more bearish the day. And you can see that there's really no bearish days there. If it goes in a sense of how many total candidates, bullish and bearish, and it's about equal, like you see on the 19th there, or on the 18th, it goes a slight little bit more bearish. It'll go a little bit darker yellow into the red. But for the most part, this was a bullish month with some neutral days. And we have some clients and some students that are colorblind. So the red, yellow, and green wasn't really that decipherable. So we decided to put the total number of candidates in each of the days. So if you start even on the first, you see a total of 136 stock and ETF ideas. Of those 136, 130 show a bullish pattern, meaning the stock has proven to go higher over a date range starting on that first of the month, and it's calculated to do so anywhere from 90% to 100%. So if you look at the back 10 years, you'll be able to see that 9 or 10 out of the last 10 years, those stocks have made an average price move that percentage of the time.
That's right. And I want to mention also, let's go back to January. So here's January 2016, and we came into the new year not looking so hot. In fact, we had Amazon as an outright sell on the 4th, and that's a stock that actually ended up getting away from us. I mean, it dropped down and it just kept on going. So if you look at the overall calendar, when did the market actually bottom out? It bottomed out around the 15th, 15th to 18th. In fact, I've actually got 119 on my screen was the actual bottom, which was the day after, was that Martin Luther King Day, I believe? We had the 19th, and we started moving higher. Look what happened. We ended up going green, green, green on the screen. So we got more bulls and bears. But this overall gives us an idea of what the overall market's looking like. So we go into February, we get a push up, then we get kind of middle of February, start getting a little bit sideways again, which is exactly what ended up happening in the middle of February. And look what ended up happening as of late last week. We started seeing green again on the screen. I started pushing a lot of the webinars I was talking about, and even in my publications, I was saying that this market really has the risk is to the upside that it's going to break. And of course, we finally started seeing that happening over the last week or so. And so I want to show you first, what does March look like? All right, so we're in the month of March now, and I got to tell you, looking at the last 10 years, the patterns are mostly green heading into March. All right, so there's a certain pattern out there called buy in November and go away in May, and that's a nice long-term pattern. But we actually have the ability to look at month by month, looking at the top 400 stocks to give us an idea of where they are wanting to go based on historical patterns, which, by the way, included the financial crisis back in 2008 and 2009. All right, that's built into this thing as well. So from here, what I do is I go through. And so today's the 3rd, or what? Yeah, is that yeah? What day? What is today? Today's the 2nd. I don't even know what day it is. We can look at the 3rd. So let's look and see what tomorrow has in store for us. So I actually click on that day, and I get all these stocks here, and I see. First of all, here's some greens. These are all bullish patterns that are 90% or better. And there's my bearish patterns down here at 90% or better. You know what's interesting? The bearish patterns I seem to find are more short term on average than the long. And that kind of goes with that phrase, the bull takes the stairs and the bear takes the elevator. Fast move down, slower move up. Right? So I'll do that. And then what I like to also do is I like to look over here at average profit. Average profit in the last 10 years. And look what rises to the top for tomorrow. And this one's actually been clustering around for the last couple of days. And that's ISRG, right? Intuitive Surgical. So what I'll do is I'll actually just click on that. And then I can get an idea of what's going on. All right, between March 3rd and April 8th, we've got a really nice bullish pattern going on here. And I find everything out from my net profit to my average trade, the percent accuracy every year and what it did during that time pattern. Look, 2013 was the only year it went south, but every other year we saw this pattern move to the upside. This gives me reason to start looking at ISRG as a potential trade candidate. So what I do is I'll go and, as a rules-based trader, I've done my back testing, all right? I used to do this manually. Now the computer does it for me. So I can go through and I can say, all right, I got a back-tested 90% pattern. It's hitting on average trades of over 23 points on the move. All right, so that's good to know. So, and it's going to happen, and the best time to be in is between now and April 8th. Guess what? I got my price 23 points higher. Let's round that up to 25. I think it was 23.31. We'll make it 25, so strikes look good. 25 points higher between now and April 8th. Guess what? Got my price, got my time. I only need one more thing. I just need to figure out volatility. I need to figure out if the option trade makes sense. So let's pop on over to stock and options. And here's ISRG. And what I'm doing is I'm looking at April week 2 and April week 3. Now, the reason why is because I don't know Week 2 actually expires on April 8th. Okay, that's the last day that this particular position is supposed to go up. So that's perfect. That's the ones I want to look at. So I can cancel and kill the April week 3. So I'm looking at April week 2. And I see here that this is a $573 stock. So we have it going to potentially $600 between $595 and $6. Now remember, I look at this board here the way I look at a board when I'm at the mall. And I don't go to the mall much anymore. I don't know many people that do. All right, most of us do our shopping online, especially if you're a trader. For me, I don't have time to leave the screens. So, but if I look at a mall, the first place I go, because I'm one of those guys, I don't browse around the mall. I will go in. I want to know where the Apple store is. I used to want to know where the Radio Shack store was, but that was decades ago. But I know where the Apple store is, and I want to know where's the Apple store, and where's the fastest way to get there. So that's you are here, and then you want to go there. Okay, so you are here is where we are today. And so let's just look, for instance, of what that 575 call is going to cost me. All right, so my 575 call is going to cost me $16.60 times 100, or $1,660. Now, where do I want to go? Well, I want to go to 600 because that's what the money calendar is projecting. And it looks like we're already off to a good start. Now, if that's the case, let's come on down. Oh, by the way, check this out. Here's your volatility. By answering in the Q&A box, based on this graph right here, this being low, this being high, do you think these options are expensive or cheap in terms of this graph right here? How many of you say expensive, and how many of you say cheap? Cheap, just put it into the Q&A box so I can see if we're learning here. Cheap, 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 cheap is the correct answer. And the reason why, Omar even said very cheap, is because what we're looking at is we're not looking up here, all right? This might look expensive to you. All right, if you're new, you're going to say $16.60, $1,660. That's kind of expensive. Well, it is in terms of absolutes, but in terms of where it's been, all right, in terms of volatility, this right here, this is a gauge of what these options trade at in terms of price. We're on the cheap side right now. This blue line represents where we are today. All right, this is fantastic. This tells us that these options are cheap. Now, are they cheap in terms of absolute risk? Some might say yes, and some might say no. But what I want to next do is I want to get an idea of what could we make if the stock goes to 600? Now my upper says 689. I want to change that to 600. And I'm going to click on risk graph. And now I'm going to come back and I'm going to say, all right, here we are today. This is my red line today. If we go to 600 tomorrow, then this option is likely going to make $1,640. All right, it's about a 1-to-1. That's theoretically what it would be worth. If we jump to 600 tomorrow, this will double. What happens if it takes from 37 to 25 days? What happens if it takes 12 days? Then we look at the 600 at the blue line. All right, it's going to make $1,377. What happens if it takes from 37 to 13 days? That's my green line. All right, so now the profit's a little bit less than $1,100. So you see what I'm doing? What I'm doing is I'm getting an idea of, I know how much this is going to cost me. I know what my risk is. My risk is $1,660 if this thing just flat out goes down or stays sideways and I stay in the trade until expiration. But if the stock goes higher, where do I make my double, and where do I exit out if it hits 600? Because if it hits 600, that's my profit target. That's when I want to get out. All right. Matt says I got a cheat sheet. I do have a cheat sheet. It's kind of right here. And you ask if there's a cheat sheet that we can share. And you know what that cheat sheet is called? It's called what ifs. And what ifs are something that we have within Tom's tools where you can actually go in and you can see, what if the stock price goes up? What if the stock price goes down? What if the stock price stays sideways over a certain amount of time? And you get this big table and it gives you what ifs on the price. But I really want to show you visually this by moving my mouse around. All right, so this is a good one, but the big question is, can we make it better? Can we make this better? All right, can we make this cheaper? Can we make this assured of a double or greater if the stock price hits 600 on or before April 8th, 2016. All right, and that's something we have to think about as we go through and look at this. All right, and some of you already know the answer to this, and that's fantastic. I know my partners are in here; they're already giving me answers. But this is one example of a trade that. What did we do here, guys? We didn't think it was going up. I don't think anybody came in the room thinking intuitive surgical was going to go higher. All right, some of you may have done some technical analysis or fundamental analysis, but I'm offering to you here tonight a case study based on time and price. All right, based on repetitive patterns, and there's no guarantee it's going to go up. There's no guarantee in it. There's no guarantee in anything in the markets. All right, but when I see the same pattern that happens over and over and over again, I'm going to slant to that side because that's the type of trader that I am. All right, based on back testing, based on creating rules, based on entries and exits. We have all three of those right there. All right, let's see if there's anything else we can look at here, and we there may or may not be as we move forward. So we had two discussions here. I, in fact, actually looked at some bearish case studies. I really didn't like any of them because they really didn't have some decent opportunity. So we walked through the case studies we discussed today. We talked about RMD and ISRG. Let's go back to those one more time and get some details. So if you remember RMD, and here's our RMD graph as I start to bring down some of these charts here. RMD, we're looking at buying the April 55 call for $3.12. Okay, what's our exit? Our exit on this is going to be in 30 days, or if this trade doubles in value, whichever occurs first. Okay, and guys, this is a case study. If you've never done this before, just put this in your, write this down and follow this and see how it does, and see if it goes up or down. See what happens and how this rotates out. Okay. So there's RMD. Let's take a look at intuitive surgical once again. Intuitive surgical is we're looking at buying the ISRG April 2016 week 2 575 calls at 1660. All right, that's $1,660. Now the reason I want to show you these is because these are the two case studies that I wanted to present to you tonight. And here's your homework assignment. Can we make either two of these trades? I got two S's in there. Remember, my strong point wasn't English. Yeah, thank God it's math. Make either of these two trades above the RMD and the ISRG trades better. And if so, how? Okay? And I'm going to tell you right now, I'm going to give you a clue. There's a different answer for each of these two. There's a different answer for RMD than ISRG. So it's not as easy as you might think. And on March 16th, we're going to review this in our week 2 session. Why am I not doing week 2 next Wednesday? Because next Wednesday I'm going to be down under, okay? And I'm not quite sure what if I'm going to have nice high-speed internet access. And if my wife sees me on this computer teaching you guys something when it's been years since I've walked away from this computer, I may not make it back alive. So we're going to take a week off. And what I want you to do is I want you to follow these opportunities. And I want you to see, let's just watch and see what they do. And we're going to come back and we're going to see if we can make these trades better. All right. And if we can, how? So what we're going to do when I come back on the 16th is we are going to discuss the following. We're going to go back over calls and puts very, very briefly. We're going to go back and we're going to come back to today's date. We're going to go back into the past. We're going to go into today's date. We're going to look and see what is going on with both RMD and ISRG from today's date heading forward and see what happened. All right. We're also going to see if we can make these better, and we're going to talk about the loophole trade, or what's more commonly referred to as debit spreads. Right. I'm also going to talk about credit spreads. So when we get back next Wednesday, it's going to be a little bit of a long. It's going to be at least 90 minutes. It might be even longer. It might be 2 hours. I hope you're okay, guys, with that. All right. So I wanted to make sure that you were aware of that. Last thing I want to mention to you, if you're here for the very first time, you want to check this out. So we have a free trial on our trading tools, and you're welcome to go to that free trial by going to tomsoptiontools.com. Let me put that in the chat window box too. So that is going to be HTTP. I'm going to put the whole thing in there for you. You just got to click on it. Let's see, www.tomsoptiontools.com. Now, I like to say my option tools, they're not the slickest thing out there. All right. But let me tell you, what's under the hood is what counts. And we've got a massive, massive engine under the hood. And so I'd like you to take a little test drive on that thing. You could take a free trial, and you could it's a full trial. We don't give you a half trial. We give you everything we have. You pick the package you want to do a free trial on, and we'll give you a free trial on that. And you can use it all the way up into those 7 days. And if you decide you don't want it, just cancel the free trial. Just cancel the trial before it's over. But what I want you to do is to go in and take a look at it. And I'll do this for you. For those of you that sign up for that free trial, I'm going to be sending you a video collection. All right. And that video collection is going to be a group of how-to videos. How to create trades, how to search for trades, how to use Double Finder, how to use DarkNet. Or I'm going to send you a webinar on DarkNet. I'm going to send you a webinar on Money Calendar, which we have a lot more details that we get into on how we use those particular tools within our trading room. So that being said, let's see, guys. If you have any other questions, I would ask you to please email us support@tomgentile.com. And we will try to answer questions as much as we can. Let me tell you something that I didn't mention also. We don't give investment advice, okay? If you email us and you say, what do you think of this? What do you think of that? What should I do with this? What should I do with that? I can't answer that stuff, all right? And none of my guys can. My team can't do that either. We are not registered investment advisors, all right? We're here to educate you. I like to think I'm pretty good at this, all right? But I educate in a room like this that allows me to in this classroom type environment. If you have general questions on the strategies that we've talked about tonight, all right, or maybe you have questions on some of our tools or some of our advanced classes or things like that we teach, you're more welcome to ask us, and we'll answer them. If you have questions on the homework assignment, as long as they're general questions, then feel free to ask us as well. Otherwise, Jay, any parting thoughts for the night?
You're going to have the recording available via email within a short little bit, correct?
Oh, yes, sir, I am. Let's see. What time is it right now? It is 9:31 p.m. here on the East Coast. I will have that to you in 90 minutes or less.
Is it also going to be available on your YouTube channel?
Yes, it will be. It will be available. I mean, I'm going to send you the link. All you got to do is just click on the link, and there you go. You're rocking and rolling. And if you want to subscribe to any of the other videos that we have, guys, you can do that on our YouTube channel, and I'll give you a link to that. Well, you'll have a link to it when you go and view the webinar that we're doing tonight. So remember, this week it was options essentials, calls and puts, and then a kind of a look into Money Calendar and DarkNet and how we actually find opportunities. Next week, we're going to look at ways of reducing those Priceline.com and those intuitive surgicals and those big name stocks and bringing this down to hundreds of dollars, not thousands of dollars, and bringing the break even closer to where we are and giving our percent to double a much healthy injection of happening. I know this because, we do this. We talk about this. I've taught and I've used case studies like, this year, just as an example, Citigroup. We had a really nice trade that we did in Citigroup, Priceline, Cree. We missed Amazon, but boy, that one surely went in our direction. And, we've talked about trades like GameStop. We have talked about intuitive surgical as well. And, we talk about these as case studies. I've done some publishings on some of these as well. But my job here for you tonight, guys, is to really teach you how to fish, teach you how to be fishermen and how to find these trades yourself. So you can find them not once a week and not on a specific day of the week, but on the days that you feel those opportunities exist. So That being said, thanks a lot, everyone. Have a great night, and I will see you again on the 16th. I'll make sure I send a reminder to you to let you know when we're going to be starting on the 16th. And hey, have a great trading week. See you soon.